We've got a powerhouse lineup for you today.
A lot will depend on the Fed and inflation. If the Fed doesn't lower rates and inflation stays at 3 and the economy slows a bit, stocks are going to make a whole lot more progress this year. On the other hand, if we're surprised and inflation does fall, the 24P gets justified and earnings take the stock market higher. I hope that's the case. Not sure it is.
That is Bob Dahl, Chief Investment Officer at Crossmark Global Investments, Wall Street veteran who's worked at BlackRock, Merrill Lynch, Nuveen, Bear Stearns, Oppenheimer, and more. He's here to review the forecast he made at the beginning of the year. And in a year that has been wild, the most wild thing might be he's on pace to get virtually everything he forecasted correct. He's our big interview, but we start with Jim Lee, the founder of StratFi, here talking technicals. And then Nick Majuli, Chief Operating Officer at Ritholtz Wealth Management, is here talking about his new book out today, The Wealth Ladder, Proven Strategies for Every Step of Your Financial Life.
Hey, Fatso, let's go! I'm not doing this for my health!
No, indeed, you're maybe doing this for your wealth, but not so much your health. Let's go, because we have a great show for you. This is Money Life for July the 22nd. I'm your host, Chuck Jaffe. Thank you so much for taking the time to join us. We know that it's the summer doldrums, but we're not slowing down and saying, oh, let's do lesser shows or phone this in. No way. And we love this lineup because, well, Nick Majuli was just on the show like 2 weeks ago talking broadly about the market, etc. But his book, The Wealth Ladder, well, some of you will find it unapproachable from the standpoint of you're not expecting to make as much money as you could ever make to get the last steps of the ladder. But you will also find it very approachable when he talks about, hey, if you've got a certain amount of money, here's what you can spend like every day and not damage your wealth. That right there makes the book worth doing. And by the way, at the end of the show today, we have a contest. We're giving away a couple copies of Nick's book, and we're giving away a couple copies of The Almightier, the book from Paul Vigna that we discussed on yesterday's show. So Rob Floyd, my executive producer, will join me at the end of the show, and we will have a little discussion there. Meanwhile, of course, the thing that everybody wants to discuss is the stock market having gotten back officially to record highs. But it's not just that we've had record highs. Like, that's not the only thing you should be looking at and considering. Jeffrey Hirsch from Stock Traders Almanac, who has been a guest on this show many times, he noted yesterday that the S&P 500 has been on a low volatility streak where it's been 18 consecutive trading days without a 1% move. Historically, when it has a low volatility thing, you wind up with the market retreating when that streak ends. The longer a historical low volatility streak persisted, generally the weaker the S&P was during the 3 months when the streak ended. Past streaks that lasted between 26 and 30 days or longer than 40 trading days were noticeably weaker. So what you'd like is maybe a day that moves at more than 1% right about now and makes it that we're not looking at something that could get extra weak. But there's your technical statistic if you're looking for one. And I don't mean to make it that like, hey, we had something good, now make it that it's benign or whatever. One other thing when it comes to the market having gotten back to record highs, there is a huge temptation, and I understand it, I'm not immune from it, to take a look and go, the market's back to record highs, it's recovered. If I haven't looked at my portfolio, or even if I have, let's take a look now and get a value with this new record high. Now, there's nothing wrong with doing that. But the problem comes when you then internalize the numbers. When you go, look at this. I now have a new number. I set that as a high watermark. Well, you know what a high watermark is? A high watermark is you've made a mark that the water got this high, and then the waters recede, and you can still see that mark and go, look at how high the water got. The problem becomes that when you look at your portfolio at highs, you tend to internalize it. I talked about what happened to Gail when the market went through tanking. And the issue was that because she doesn't normally look, when she looked and she heard what the number was, then when the market tanked, she's like, oh my goodness, look at how much money I've lost, which she never would have done had she not looked. Now, I'm not suggesting you don't look at your portfolios. If you're somebody who comes to Money Life, you are looking occasionally. Come on, you are. You're interested enough to spend an hour a day talking about money and markets and personal finance. You're looking occasionally, and there's nothing wrong with that. You could look every day, you could look every minute. It's more about how you act on it. But a market high is particularly disarming for people who don't normally look, because they are the ones who are going to come in, take a look, internalize that high, look at how much money I've got. And then when the market just moves normally, has a little correction, does whatever, they tend to be freaking out that much more. So it's not bad to look, make sure that you've recovered, make sure your portfolio has done what you've expected it to do. Maybe take a look and go, where am I in terms of gains this year? And again, I talked about the fact that Gail's portfolio all tied to the market, my portfolio, stocks and bonds, much more well diversified. So in a year like this one, I want my gains to be not just what's the S&P doing or what have you. That would be wrong. I'm looking for something different. But make sure, if you're looking at highs, that you're not looking at your portfolio without an eye towards, is it doing what it's supposed to do, which is not set record highs. It's perform the way you want. Get as much of the upside as you were hoping to get. Avoid downside. Did you avoid some of the downside, et cetera? Because Gail took the entire brunt of the downside, and I didn't. And yet we both recovered. In her case, she doesn't normally look. So it's not, is the portfolio where she expected it to be, other than has it recouped and ridden back up, which it has. So, and I can tell you that because I now look much more than she does, because she's like, yeah, well, you should be taking a look at it. And still, we haven't gotten it rejiggered, because there's an issue that she has to do to be able to make it that we can move money around. So I want her to do that so that I can get that taken care of in case we wind up seeing the volatility. Right now, however, we've got a great lineup to get to. Bob Dahl, always great to chat with him. Jim Lee, a really interesting take on technical analysis. And Nick Majuli. It's a great day to live the money life. So make sure you're here all the way to the end. Get involved in our contest. Write me, Chuck at moneylifeshow.com. Tell your friends about us. But right now, settle back and relax. We'll kick things off talking technicals when we come back in a moment.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Don't get technical with me.
But enough of my technical mumbo-jumbo. Allow me to demonstrate.
Welcome to Talking Technicals on the July 22nd edition of Money Life. Returning to the show today, Jim Lee. He is the founder of StratFi. Strategic foresight investing, if you will. But StratFi, just like it sounds, and you want to know how it sounds so that you can spell it, because stratfi.com is the website. And Jim Lee sees technicals as a tool for short-term forecasting and for optimizing the system, the entry and exit levels. And he's built a system that looks at seasonal and cyclical and calendar factors and more. And then he's built portfolios that, it's not that they're tongue-in-cheek, but they have a really good approach. Like, he's got the caffeinated timing strategy, which obviously caffeinated, a little more aggressive than the decaffeinated strategy. He's got the East Coast strategy, which is different from his West Coast strategy. And again, it's about which one's for conservative, which one's a little more for growth and aggressive investors. By the way, West Coast, more aggressive. If you want to learn how it works, stratfi.com. Jim Lee, welcome back to Money Life.
Great to be here. I think we last spoke probably about 6 months ago or so.
Yeah, it was about 6 months ago, and we've had this wild ride for the market. But from a technical standpoint, if you just make it that you're not looking at it day by day and you're kind of looking at the long-term trend, the trend has been up. So the question, I guess, given that you've got the caffeinated and the decaffeinated portfolio, I'm not a caffeine user. I'm not, because I find that it would give me jitters. But I guess the question is this a time for investors to be a little more caffeinated or a little more decaffeinated? I mean, where are we in this cycle where we've gotten back to record highs, but there's plenty of nervousness out there? Are you thinking more about entries or exits?
Well, let's wind back to our last conversation, which was very much in the beginning of the year. As you mentioned, I look at cyclical, calendrical, and seasonal factors to inform what happens next. Last time we spoke, I was beginning to take some money off the table from the markets, cashing in on some of the substantial gains from last year. And lo and behold, we had a near miss of a bear market running between January through the lows of April, where the S&P was off by about 19.5% on Trump's trade tariff tantrum, as it were. And then subsequent to that, we've regained all of those losses and then some, such that the S&P 500 and the NASDAQ are now pushing all-time highs. So it's been quite a ride for a lot of people.
We've seen decreasing market activity around getting towards certainty. You'd like to think, hey, if we have some measure of certainty and we know a little bit more how tariffs are going to look or what have you, we would see the market go, okay, now I can move strongly one direction or another. But instead, what's happened is you get the first tariff announcement, big market move. The second announcement, smaller move.
Mm-hmm.
This last announcement, not really much move at all. And who knows what we're going to get to in a couple of days when we get to the August, okay, now they're really being here. So is that the market has now priced it all in and figured it out, or is that uncertainty is less uncertain right now?
It is kind of interesting because we've had a lot of headline shock, a lot of headline news over the first quarter of this year. And now the market's seeing some updates and it's kind of responding with a yawn, right? When I look at the charts, I see a relatively smooth, orderly progression that's been going on over the last 2 or 3 months. And most of the trend, most of the momentum indicators seem to be behaving just the way that you would expect them to within, a typical bull market, right? With a 50-day moving average leading the 100-day moving average, leading the 200-day moving average. And from a trend perspective, things are looking pretty good. Now, inside of that, you also want to look at something called the market internals, which is a way of differentiating where the leaders are versus where the laggers are. The market being dependent upon just this, 7 individual stocks, the Mag 7, as it were, or is the breadth, the leadership broadening to, include more stocks? And we've started to see some of that happening as well. Since the beginning of the year. So from that perspective, this looks like a healthy advance with broader participation. One way to look at this is to look at the S&P 500 index, which is what's called a capitalization weighted index, whereas bigger companies have a bigger weight in the index versus what's called an equal weighted index, where all 500 companies in the index are treated exactly the same. And lo and behold, the S&P 500 equal weight index is also hitting new all-time highs, which is worth mentioning that some of these gains are being shared by some of the lesser known companies as well.
In sharing them, do we have enough breadth? Like, have we seen it actually broaden out, or we've just seen a slight increase in participation? Because it still seems like everything's leaning towards the biggest of the big.
It is still leaning towards the biggest of the big. And there is one segment of the market which is technically overbought right now, which is that large cap growth component, in particular the semiconductor stocks. And there is a segment or two of the market that have not caught up with everything else, and that'd be the small cap stocks, which are still a ways off from hitting their all-time highs. So I would like to see more of a rotation going into that small cap segment of the market, and we have not seen that yet.
One of the reasons why I like the caffeinated versus decaffeinated, et cetera, is that the guys who market mutual funds or what have you wind up saying, let's look at an absolute return fund, et cetera. Well, who wouldn't go for caffeinated if you didn't feel there was much downside risk and what have you? But I'm curious, right. I know that these are all your children, so you don't have a favorite. But if given everything else you are looking at, if somebody is new to your work now, do you tend to think this is a time to be more caffeinated, more risk on, or a little bit more defensive and a little bit less caffeinated?
I'd say that this particular market, as of this month, has been more conducive towards just pure buy and hold investing, right? You have some seasonal strength for the market through the mid of July. If you want to look forward, you tend to have a little bit more choppiness happening in September and October. But the long-term trends have been, I'd say, quite benign for stocks overall. I tend to be somewhat bullish at this time. And in terms of if you wanted to put a number on the wall, my expectations for the S&P is gains of 5 to 10% for the second half of the year. So I think it's good. Optimistic. Timing wise, I think it's a decent time to buy and hold, but I'm not all in. I still have a 20% allocation to cash and fixed income.
5 to 10% means you're looking roughly S&P 6600-ish, up to about 7,000. That number keeps coming
That's
up.
correct.
I'm talking to a lot of folks. It's been coming up again and again. Is that an indication that if you're looking at the same kind of numbers and you see where we're at and we don't see rate cuts happening or what have you, this is basically as much as the market can squeeze out in a time of good fundamentals, but a lot of concern?
That is correct. That is correct. It says that a lot of the gains may be behind us and that we should be thankful if we continue through the rest of the year at this rate. I don't think that's necessarily going to happen. I don't think that we're set up necessarily for a bear market or a down market, but I think a slower rate of growth for the second half of the year would be reasonable.
So slower by how much? And, just as you said, you're keeping 20% sort of dry powder just in case because you're not fully sold. What are your thoughts on what could trigger a downturn for you? I mean, what's your nervous scenario?
The nervous scenario for us is what if inflation does come back? Inflation numbers have been relatively well behaved this year because tariffs have not kicked in yet, in part, right? If you see some of those tariffs, if you see some of those cost hikes being passed on to the consumer, you're going to see a stiffer monetary policy put into place. You may see interest rates start to nudge up a little bit. We all hope that doesn't happen. You got to remember, you look at a month or two ago, people were expecting that the Fed would cut rates in September. And now 90% of those surveyed are basically expecting interest rates to stay the same. That also ties into, again, looking at small caps versus large caps. Small cap stocks traditionally are much more exposed in terms of interest rate sensitivity. And we might not get that late stage raging bull market in the small cap stocks without lower interest rates. So I think keeping interest rates where they are is going to put a cap on the appreciation potential for the market.
The other thing that's been interesting, and I recognize you look more at the market, but you also do look at macro factors, has been watching how forecasters have kind of changed their recession expectations. They entered the year thinking low chance of recession. They got to Liberation Day and said, high chance of recession. And now they've come back to no chance of recession.
Back on that.
Yeah. Where are you on that?
We are in a lower growth environment, but still expansionary. In some ways, you think of it, it's kind of like a Goldilocks type of situation, right? It's not too hot, it's not too cold, it's just kind of right at this point where we have CPI growth at about, 2.6%, unemployment at 4%, anything below 5% is considered to be full employment. We continue to have earnings growth, particularly within the tech stocks. If you just look at the economics and stay away from the politics, things are looking pretty good. But the politics, of course, are what people pay attention to, and that's really what muddies the waters right now. That's what takes the clarity out of the market at this point.
You help us get some clarity. We really appreciate your help and your time. Jim, great chatting with you. Let's do this again as we get around the turn of the year. We can start to look at what's going to be happening in 2026.
Wonderful. Thank you so much.
That's Jim Lee. He is the founder of StratFi, which you can learn about at stratfi.com. And I want to point out, by the way, that, this is a company that has assets of around $100 million under management. And they just got what's known as GIPS GIPS, GIPS verification. GIPS verification is something done by the CFA Institute. It's called Global Investment Performance Standards. And if you have it, well, then you can basically say, hey, here's our track record. So you see a lot of guys who are newsletter editors and what have you, and you have a tough time finding their track record. You won't have that same trouble finding Jim's track record. So if you want to find out what they've been doing at StratFi, yeah, now you know, stratfi.com. But also, if you're looking at folks and you're going, where can I find it? Find out if they're GIPS verified, because if they're not, that's one reason why you may not be able to get some of the performance data that you're looking for. Hey, up next on Money Life, Nick Majuli from Ritholtz Wealth Management talking about the wealth ladder, then veteran Bob Dahl from Crossmark Global. This is Money Life.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Did you know that there are at least 23 million American adults who can't read a want-ad?
It's called reading. Top to bottom, left to right. Group words together as a sentence.
Money Life presents
I'm chatting with my guest, author, lecturer.
You get him to open his mind and his future.
The Book Interview.
Give a kid a book and you'll give a kid a break.
That's gonna be radical, Chuck.
Reading is good. Can we start the story now?
We sure can, and the story we are telling today is one that's going to help you figure out how to work your portfolio and work your money no matter where you are in life. It is an important story, and I really love this book. It is The Wealth Ladder, Proven Strategies for Every Step of Your Financial Life. The author is Nick Majuli. He is the guy behind the Of Dollars and Data blog. He is the chief operating officer at Ritholtz Wealth Management. He's written books in the past, including Just Keep Buying, Proven Ways to Save Money and Build Your Wealth. And the Wealth Ladder builds on that. If you want to learn more, again, you can get everything if you go to Of Dollars and Data for the blog, and there's links there for everything else you need. Nick Majuli, great to have you back on Money Life.
Thanks for having me back on, Chuck.
I love the book because most people really struggle to transition from one area of life financially to the next and the next. And this kind of lays out that plan. Was that the reason why you felt the book was necessary? That as your clients have grown with you, as you experience more with others, you sort of took a look and said, where people get into trouble is they kind of find one thing and they stick with that forever?
Yeah, I think people fall into their habits. And so you can keep doing the same thing for a very long time and not realize like, oh, maybe I need to change up my strategy to keep making progress, right? And there's a lot of points. I've noticed this in my personal life. I've had, prior jobs where I was like, okay, I basically maxed out where I was and I could just see, my 3%, 4% raises every year for the rest of my career. And that was going to be it. Or I needed to change it up and do something different. And so I think for me, that was kind of there were different points in my life that really had me thinking about these types of things and saying, hey, maybe your strategy should change over time. Like Just Keep Buying, which was my first book, is a great strategy, an initial strategy. But if I know more about you, maybe someone who's deeply in debt, that's not the thing they need to be doing. Or someone's trying to get to, over $10 million in wealth, that's also not the thing they need to be doing. The strategy would need to be different to get there.
The book breaks things down into levels. Think of each level as a step on the ladder. And those do have to do with assets. How much, when people start the journey, is it important that they can see the end of the journey? Because so much when I talk to young people, they struggle to see themselves ever being able to do any of the things that occur in the middle to the high steps on the ladder.
Yeah, so a lot of it is really thinking through, okay, well, to get to there, I need to obviously, save money, invest money, et cetera, get a higher income. And so there's a lot of different, sub steps, I would say, on your way to different levels on the wealth ladder. And I can talk about those. It really depends on where you start, though. And so for most people starting, let's say level 1 or level 2, depending on, kind of your family and stuff, that's going to determine, where you can, maybe if it's just time, you just need time to get there. Or if it's like, oh, I actually need to get an education or a different set of skills or something so that I can make sure I climb the wealth ladder.
You do get to very high levels. And of course, at Ritholtz Wealth Management, you do work with some incredibly wealthy folks. For most people, that's not the level that they need to get to. So how do we help folks recognize that there comes a certain point where you go, now I'm set for life, without somehow every time you get something better, you kind of just keep raising your aspirations. If I have a car, I could get a nicer car, a bigger car. I could add a boat. I could do whatever. And maybe that's fine. That the irony of it is that you watch people who can spend huge amounts of money, relatively speaking, because they have enormous amounts of money. They're spending less than the average person is when they go, oh, I need a new laptop, right?
Yeah, yeah. On a percentage basis, that can definitely happen. And so it's a question of like when is enough? And this is a bigger philosophical question that, people have thought about for a very long time. And so I think it also depends on where you are on the ladder. And so just to walk through the 6 levels briefly, if that's okay. So
Yep.
this is all based on your net worth, which is all your assets minus all your liabilities. So take everything you own, your car, your house, your stocks, cash in your bank account, put that in one column, subtract everything out that you owe. So your mortgage debt, student loans, credit card debt, and that gets you your net worth. Hopefully it's a positive number, right? Then from there, you're in one of the 6 levels, right? And the wealth levels are factors of 10 off of each other. So to go up a level, you multiply by 10. To go down, you divide by 10. So level 1 is less than $10,000 in net worth. Level 2 is $10,000 to $100,000 in net worth. Level 3 is $100,000 to $1 million in net worth. Level 4 is 1 million to 10 million. Level 5 is 10 million to 100 million. And finally, level 6 is 100 million plus. And the nice thing about these levels is they actually map onto the US economic classes quite well. So 20% of households are in level 1, 20% are in level 2, around 40% are in level 3. That's 100,000 to a million. That's roughly your middle class. I mean, obviously it depends where you live, but that's what I would say is the middle class. There's about 18% in level 4. That's about 1 to 10 million in wealth. And then the top 2% is level 5 and 6, with level 6 there's only like 11,000 households in there as of 2025. So it's a very, very small group of people that have over $100 million in wealth. But from that categorization, you can then see, okay, well, depending on where I'm starting and, kind of my age, and there's a lot of other factors like, age is correlated with the levels. Like the median age in level 4 is 62. So people with $1 to $10 million in wealth, you put them all in a room and you took the middle age based on age, they'd be 62 years old. So age is a big factor here. But in addition to that, your income matters amongst some other things.
In the end, what I found very interesting was after you talk about the levels in the book, the first thing you do afterwards is kind of go, can money make you happy? How much is that lost when people are climbing the ladder?
I think it's only lost on the people who are unhappy and they're using money as a tool for happiness. And it really depends. If you're unhappy and you're pretty poor, like let's just say you're level 1, like you don't have a lot of assets, you don't have a lot of income, more money is going to make you happier. And the reason why is because most of your problems are likely money problems. But once you start getting out of level 1, you're into level 2, and especially once you're into like level 3, if you're not happy, money is not going to make you happier. And the data on that is pretty clear. However, if you are happy, more money is going to make you happier. It's this weird irony based on the data. Like if you're happy, more money would make you happier. If you're poor, more money would likely make you happier. But if you aren't happy and you aren't poor, money's not going to do a thing. So it's funny because the people that are looking and reading all these things like, oh, can money make you happier? Maybe I'm not saying all people that read these articles are unhappy, but I'm just saying if you're looking to money as a source for more happiness and you aren't already happy, that's the problem.
Do people also need to unlock the happiness that money can bring? I think here of a guy who, Rich in Orchard Beach, Maryland, one of the biggest fans ever for this show, who passed away suddenly in February. And Rich and a whole bunch of our other audience members identified when we talked about this after he passed, sort of famously had worked to where he had everything he needed. He was, 70 years old, and he couldn't bring himself to spend money very easily, which a lot of folks have. You're going from accumulation to spend it down. And he told the story of how, he and his wife, Allison, needed to go to Colorado Springs to see family. And, he had a bad knee and she had a bad hip or the other way around. And it would have been a lot more comfortable flying first class. But have you seen what those tickets cost? And he couldn't bring himself to do it. And yet he had no heirs. He had more money he could live with for the rest of his life, et cetera. So how much, as we spend our time focused on climbing the ladder, do we also have to get our utility out of our money and allow ourselves to get our utility?
Yeah, and I actually address this very question in the first chapter, which is on spending money. And so there's this idea I use called the 0.01% rule. And the idea is you take your net worth, you multiply by 0.01% or divide by 10,000. It's the same mathematically. And that is the amount of money you can spend every day that's like trivial. It's a trivial amount of spending. And the reasoning for this is we just assume your wealth is creating 0.01% per day. It's returning that much to you over the course of a year. That's roughly a 3.7% annualized return. And if you assume that's true, that's a conservative return. It's not a crazy return, right? If you assume that your wealth is always going to be generating that, then you can spend that every day without thinking about it. And so I don't know, where. So depending on where you are, I'm assuming if you're like deep in level 4 and you're like, oh, well, it's kind of expensive to get this first class seat. Well, it's like, well, what's the added cost relative to a coach seat, right? It's like $1,000, right? If you're somewhere deep in level 4 where you have, let's say you have $5 million, divide by 10,000 or multiply by 0.01, that's $500 a day you can spend, no problem. And if you're only flying a few times a year, you add that up over the course of a month, you can easily afford a first class seat, right? And so every wealth level maps to what I call a level of spending freedom. So level 2 is what I call grocery freedom. You can buy what you want at the grocery store. Level 3 is what I call restaurant freedom. You can start buying what you want at restaurants. And level 4 would be travel freedom. So I don't know much about Rich's finances. I'm assuming he was probably level 4 or close to it. So he could have easily had that travel freedom. And it's one of those things where if you're in the level, like the money's going to be coming in so well that you're not going to have to worry about it. So I do try and come up with a rule or a system that says, hey, you can start to upgrade to a first class seat, but only after you've built the wealth. Like once you've shown the financial discipline, give yourself some freedom to spend the money. So I do try and, overcome those biases. But at the end of the day, some people will never be able to do that. And I understand why. It's behavioral. It's a very big behavioral issue.
Is that ultimately the biggest problem that folks have as they climb that ladder because they started with nothing and they remember what nothing is? I mean, your childhood traumas and whatever it is and however your parents dealt with money, we all know that sticks with us. As we climb the ladder and we move from one level to the other, how much do we as people have to evolve?
I mean, I think you do a little. Of course, at the end of the day, like it's tough. It's tough to overcome those biases, right? But I think the whole point of this, and that system and that rule is like, hey, you can spend a little bit more. Look, your wealth is throwing off this much every single day. Even if you spent that money every day, your wealth would remain stagnant. You wouldn't lose money. You would be stagnant spending that extra money, right? So that's the argument I have is like, you have $5 million, you can spend $500 every single day and you would not see any change in your wealth, right? That's just going to show like that once you start to have money, that money is just throwing off so much income that you can live off that income and then some, right? So if people don't know that, they may not think of it this way. And so I hope it helps some people.
Yeah, I think it will help them. I think the book will help a lot of people. It's a great read. And we've got a couple of copies we'll be giving away in a contest. But of course, if folks want to get more, they can get it at your website of Dollars and Data. There is also a dedicated website for the book. It is wealthladderbook.com. You can check it out there. But we've been able to check it out here with Nick Maggiulli. Nick, thanks so much for joining me.
Thanks for having me on, Chuck. Truly appreciate it.
That's Nick Maggiulli, Chief Operating Officer at Ritholtz Wealth Management, the guy behind the Of Dollars and Data blog. And yeah, the new book is The Wealth Ladder, Proven Strategies for Every Step of Your Financial Life. We have to step away for just a moment. That's something we have to do on our money life. But our journey, it's just beginning. So settle back, relax. The July 22nd edition of Money Life will return in just a moment. Welcome to the big interview on the July 22nd edition of Money Life. And truthfully, they don't get much bigger than my guest. Bob Dahl is Chief Investment Officer at Crossmark Global Investments. If you want to learn more, crossmarkglobal.com. But Bob is something of a Wall Street legend. He's the former Chief Equity Strategist at Nuveen and at BlackRock and former President and Chief Investment Officer at Merrill Lynch. And he was Chief Investment Officer of the Oppenheimer Funds. And I've known him through all of those jobs because we've been talking for years. And one of the things he is absolutely the best known for is his annual predictions. He always makes 10 predictions for the new year. We on Money Life discuss them with him. Basically, we review his picks at the end of the year and then start the year by talking about his new picks. And then we have him back in the middle of the year to take his pulse on where things are, both in the market and where he is in his predictions. If you want to catch up with Bob, it's crossmarkglobal.com, or you can go look at the link we've got in our show notes or on our guest page that will get you to his update on how his 10 predictions for 2025 are doing. He's got a third quarter update. Bob Dahl, always great to have you back on Money Life.
And vice versa, always great to chat, Chuck.
Let's start, before we get into how the predictions are doing, let's start with where we are right now, because I think the first half of the year, if you had closed your eyes and said in December, here's where I think we're going to be, that forecast would have felt pretty good. Like a lot of people could have gotten behind, oh, yeah, that's where we're going to be when we get to the year's midway point. But we certainly didn't achieve it the way anyone thought we would achieve it. So where are we now? And if uncertainty has been the song of the first half, how much uncertainty have we actually cleared up by now?
Well, that's a great question. I don't think we've cleared up a whole lot of uncertainty. Some we have. We've learned what the language of tariffs is about. We've gotten a little better arms around inflation, the economy, et cetera. So some of it's been resolved, but still more questions than usual out there, Chuck. And you're absolutely right. Market's up a few percent so far this year, and it seems like, well, it's a pretty normal year, and yet we had a 20% decline and a 20% pick back up. That's just incredible. To your question, where are we? I'd say three quick things. One, the economy is slowing. We just don't know how much it's going to slow. Two, we're beginning to see tariffs show up in the inflation numbers. We don't know how much. And number three, we have this tailwind called AI, which is real and is keeping things moving.
The tailwind called AI has been also particularly at the high ends of the market. We all were expecting some measure of breadth this year. Are we going to see the breadth show up at some point?
Yeah, well, it obviously occurred in the first quarter, and then it went away in the second quarter. The beneficiaries of AI, in other words, not the Magnificent Seven, but those who use it, are beginning to benefit, a little more productivity. So we're seeing some broadening, which there were more.
As for the uncertainty that you say, we're not really through it. One of the interesting things has been watching the severity or the magnitude of each move with each announcement. Obviously, April 2nd, first announcement, massive market move. Then we push things back a little bit. We get to the second time where, okay, what's going to happen as we get close to that day? More muted. This last one, I'm not sure the market even spent the time to slow down and rubberneck at that accident. Like they just kind of drove right past the July 9th date. So
exactly right. Back to we are getting our arms around it and beginning to understand. And yet there are other things that are causing the volatility as well, as you know.
But what should we make of that? Like, if that becomes normal, if that becomes something that we can literally shrug off in a day, what does that portend? Because I think it means to some extent that we're going to wind up with a lot more acceptance of like, hey, if you told us what these tariffs would be back on April 2nd, yeah, we may not have the April 2nd level, but we're higher than anybody was expecting or what have you. And the market's just going to go, okay, ho hum.
Yeah, I think there is some of that. So let me look at it from the other side. You just said it as a glass half full. Let me give you a glass half empty. We come into the year and tariff rates are on average 3.5%. Our guess is when the dust settles, they're going to be 10 points higher. Call it 13.5. Is that better than 3.5? No, it's not. And therefore, somebody's going to be paying for it. A tariff is a tax. Somebody's got to pay the tax. Consumers may pay some, corporations may pay some, and corporate profit margins. So watch this space carefully is what I'm trying to say.
With the tariffs, the thing that everybody was worried about was that we would see price increases, that it would kick into inflation. We really haven't seen it yet. Now,
yes, we have. The CPI and the PPI last week, there were clear traces of tariffs coming into goods. Not a big number, I'll grant you that, but it's just the beginning. We're going to see more of that in the third quarter.
Well, that was the question, was how bad is this going to get? Because we've gotten the first whiff of it, or at least what people think is the first whiff of it. So how bad will this get?
I don't think it's going to be horrible, Chuck. It's just going to be there. Because remember, only 15% approximately of our GDP is from outside the United States. The other 85 is pretty domestic. So it's limited by how much of the economy it really affects. Now, having said that, remember the Fed's saying we got to get inflation down to 2, and they're struggling at 3. We're not going to get to 2. And that makes all these people who want the Fed to lower rates going to have to wait a little bit.
Now let's take a look. We're going to review your 10 forecast for the beginning of the year. And there's 3 ways that you can kind of come with the outcomes. And we've done this in the past. And I will point out, we're not going to have any where we think, wow, this one.
It's wrong. Shockingly wrong.
We're not going to have any of those.
Thank goodness.
Because you're not there. But we also don't have resolution on a lot of them yet. So let's start with your first forecast was economic growth slows as the unemployment rate rises past 4.5%. That was your forecast, obviously. Too close to call or too soon to call?
Yeah, particularly the second half. Economic growth certainly has slowed. We have negative real GDP in the first quarter. Second quarter is going to be probably around 2. Full year, probably 1 to 1.5. That's a lot lower than anybody thought at the beginning of the year. But the unemployment rate is sort of stuck, actually fell in the last employment report. And a lot of the reason is there aren't enough workers. Because of the immigration change, finding workers is getting more difficult. That's keeping the unemployment rate low.
With GDP growth having turned negative, you know, the interesting thing for me this year has been watching the forecasters kind of dance with and around recession, in that they entered the year not expecting one. We got to April, it's like, oh my goodness, recession is coming. And here we are at June and the market's back at record highs. And they're like, yeah, recession. I didn't really say that it was coming, did I? So where are you on recession right now?
Yeah, so remember, long term, the U.S. spends about 15% of its time in a recession. So if you know nothing and somebody says, what's the chance of a recession? You say, around 15%. My guess is it's still a little higher than that. Call it 20 to 25, still way below 50. So probably no recession this year.
So that was your first one, was on the economic growth. Your second one is about inflation, also still undecided. You forecast that inflation will remain sticky, fails to reach the Fed's 2% target, and causes the Fed's fund rate to fall less than expected again. By the way, still undecided, but you're looking pretty good.
Yeah, this one's heading in the right direction at this point. The reason Grader gave us a question mark, unsure, rather than heading in the right direction, is we don't know how many times the Fed's going to lower rates. We go through periods where people think, it's going to be 2 or 3 before the end of the year. My guess is if you give me a choice between 0 and 2, I'm going to pick 0. They might do it once, they might do it twice, but with inflation stuck at 2%, back to what we just talked about, unlikely they're going to do much.
I've said since Liberation Day that I did not think the Fed would cut rates this year. After I heard Jerome Powell talk right after Liberation Day, I said it's going to take something bigger economically speaking to get them to cut. But I love the fact that the market keeps pricing it in, because the market has been consistently wrong for like 2.5 years now on what rates are going to do.
Here.
Is there something as an investment strategist that you want to do when the market's that out of sync on rates?
Yeah, you got to be careful because the market, look, the PE ratio in the U.S. stock market is 24 times. It is discounting a Fed couple of cuts this year. If we don't get them, 24 is too high for the PE. So you got to be very careful how much you pay for a stock. Make sure you got the earnings. Make sure you have the cash flow, because the valuation may come down some.
Now, we were just talking about the Fed and interest rates. Now let's move over to Treasury yields. Your third forecast was that 10-year Treasury yields would trade primarily between 4 and 5%, and we'd see wider credit spreads. And that one's still too close to call at this point.
Yeah, obviously we don't know where the Treasury is going to end up. My guess is it will be between 4 and 5. It's the credit spreads part. Credit spreads are tight. Believe me, the economy is just fine, thank you. I think as the economy slows a bit, no recession, but as it slows, credit spreads will widen some, but that hasn't happened yet.
Let's move on to your fourth forecast, which was that earnings would fail to achieve consensus 14% growth, and that every sector would have up earnings. And at least to this point, and now, as you point out, you have a Grader, and they take a look at what's doing. They have looked at this one and decided you're not only right, but you're going to stay right.
I think so. The consensus has cut that 14% growth rate in half. And now we have the consensus forecasting 3 sectors to have down earnings. So I think this one's almost in the bag.
which moves us along to your fifth forecast, which was that equity volatility rises with the VIX average approaching 20 for only the third time in the last 14 years.
Yeah, equity volatility, as we said at the very beginning of our little talk here, we never expected, nobody expected the volatility we saw in the first half of the year, the down 20, the up 25. My guess is because of the uncertainties, volatility will stay above normal, probably not where it was in the second quarter, but going to be above average for the year, and then we'll get that one right, even if it's a little slower in the second half.
Well, this is one of those ones where, yes, you are expected by your own grader, but also by you and me to be right on this one. But again, you may be right that doesn't mean that the call reflected the way the action got there. Like, you could have been right with a much more benign action to the market than we've seen.
Yes. Or said differently, we were maybe getting this one right for the wrong reasons.
I didn't want to go quite to that level, but yeah, you're okay. Good.
I'll fall on the sword.
Your sixth forecast was that stocks would experience a 10% correction and would fail to keep up with earnings, for such as price earnings ratios contracting. And obviously, well, we've already had the correction and we've had the recovery. So
yeah, I think a lot will depend on the Fed and inflation. If the Fed doesn't lower rates and inflation stays at 3 and the economy slows a bit, stocks are going to make a whole lot more progress this year. On the other hand, if we're surprised and inflation does fall, the 24P gets justified and earnings take the stock market higher. I hope that's the case. I'm not sure it is.
If you had to place a wager, have we seen at this point, now a little bit past the midway point, the high for the year and the low for the year? And if we haven't seen the high and the low, which are we more likely to see a new one of in the second half?
Well, as you know, we're right at the all-time high as we speak. Could it go a bit higher? Of course it could. So I'm not going to say we've seen the high. The low, I sure hope we've seen the low. It's a lot of points below where we are today, no matter which average you look at. So my guess is, barring a disaster, we have seen the low for the year.
Now we move on to your seventh forecast, which was that equal-weighted portfolios would beat cap-weighted portfolios, the average manager therefore beating the index, and that value would beat growth. And this may be the one you're in the most trouble on, right?
Probably right. Equal-weighted portfolios are not much behind cap-weighted portfolios, after being way ahead at March 31st. The growth stocks have come back so much, they're about 2 points ahead of value. So, probably in the most trouble on any of them with this one. You're absolutely right, Chuck.
And again, we talked about that breadth. Do you think that we will wind up with anything driving the breadth, or as long as it's basically the AI trade and the uncertainty and interest rates don't get cut, you can't have, without a couple of things happening, you can't have the big small cap rally?
That's exactly right. The small cap stocks typically do best coming out of a recession. We're not in a recession, unlikely to have one, so the recovery's not going to be this year.
That brings us to your eighth forecast, which was that financials, energy, and consumer staples outperform healthcare, technology, and industrials. And if we just went through the first half of the year, we would have been scoring you. But we have to stop the record there because we didn't get to stop it at the second half. And oh, by the way, here in July, doesn't look like quite such a sure thing anymore, does it, as we start the second half? So will this hold on?
I think we'll get it right. We'll hang tight. We had this prediction. I think we were 6 points ahead at March 31st. And by June 30, we're only 1 point ahead. And that's why it's just too close to call. Look, the financials have been strong. Technology has been strong. This one may take till December 31st to figure out, Chuck.
That brings us to your ninth. And your ninth is always a look at the government, which in this case was that Congress passes the Trump tax cut extension, reduces regulation, but tariffs and deportation are less than expected. And so you got the tax cut extension. You certainly have a look at regulation, but tariffs less than expected? Obviously, this one's undecided yet.
Correct. You're right. The positive things we've gotten right. The question is on tariffs. Certainly deportation has happened, but it's less than people have thought at the first year. The tariffs is the question mark here. How much of this does go through? We know that the president speaks a lot on these things, and what he tells us today is different from what he might tell us a week from now, or maybe even the next day. So the jury's out on this. We'll watch it carefully.
I'm curious because you mentioned regulation. Is there an investment play in your mind on deregulation? In other words, are you starting to look at this and go, if the deregulation efforts pick up, there's a lot of businesses that stand to, gain, if only because they're not spending so much on compliance. And is that going to be an investable theme for you?
It is, and we find it most relevant in the financial sector, which, of course, has been an above-average sector year to date. Reason is the financials, banks in particular, have lots and lots of regulations. And slowly but surely, they're being reduced. It's among the reasons the financial stocks have done well. We expect more of it and more talk about it. This has happened. There's so much going on that it's been obscured somewhat, but we expect deregulation to be a good theme.
Now, Bob, I have to say that I know from years of doing this that your 10th forecast is typically something of a softball. I think you make it, quite honestly, just on the off chance that you have some year where you get everything else wrong.
Everything else wrong.
But I will point out that here we are going to number 10. You are at mid-year looking at a possibility, like the one we just talked about, number 9, would be like half right, half wrong. You are at a possibility of getting through 2025 with 0 defeats on the board. And oh, by the way, you're not going to be defeated on number 10 because your forecast was that DOGE's efforts, DOGE being the Department of Government Efficiency, their efforts to make progress would happen, but they'd fall woefully short of the enormous $2 trillion per year of savings that they were hoping to make, which for fairly obvious reasons, yeah, that one is in the bag.
Yeah, I didn't make this one until late December. I wanted to say something about Doge, didn't know what to say. And then when Elon Musk said, and we're going to cut $2 trillion a year of savings, I said, there it is. I got it. And you're right. It was right on January 1st.
Well, let's also then take a look, because like I said, I think sometimes your 10th pick is the one that's like, okay, if I've messed up everything else, I got to have one or I lose all credibility. But
right.
As a general rule, you're not going so far out on a limb on some of these things that we would expect you to get a lot wrong. But have you ever had a perfect year? What's the best year you've ever had? Because I have a tough time believing that amid all of this craziness and uncertainty, you might not be having your best year ever.
We've gotten 8 right before. I think once, maybe twice. Our long-term average is 72%. So I wish coming into the year we knew which 7 we were going to get right. We could make a lot of money. The problem is you don't know which ones you're going to get right and wrong. And here it is mid-year. We still got more question marks than we have check marks.
Yeah, but you do have a possibility of doing even better, which is great. And Bob, the one thing we haven't talked about, what's your current take on domestic versus international? I mean, given everything that's been going on with tariffs and the talk about the end of U.S. exceptionalism, where are you on domestic versus international right now?
My sermon on this is there are way too many U.S. portfolios that are loaded with U.S. large cap growth stocks. Still, they don't invest outside the U.S. at all, maybe 2%. So I say to anybody who listen, if you're at 2, go to 4. If you're at 5, go to 10. You need some international. They're so much cheaper than the U.S. stock market. Having said that, there are reasons for that. Their growth rate's not so good. They got a lot of problems that they can't grow. But I would have some international in my portfolio for sure.
And are there specific international markets that you favor or that you're avoiding for geopolitical reasons?
So if you think the U.S. economy is okay, the derivative play on that is always the emerging markets. If the U.S. does okay, emerging markets tend to do better, and that's exactly what is happening this year. So that's a place to play. Pacific Rim that serves India, we like a bunch. Selected markets in Europe, we like Brazil and South America.
Bob, great stuff. Always is when we get a chance to chat. Thank you so much for coming back to Money Life. We'll talk to you again when we've got a pretty good idea of how everything's shaking out.
I'm looking forward to it. Thanks, Chuck.
That's Bob Dahl. He is Chief Investment Officer at Crossmark Global Investments. If you want to learn more about the firm and what they do, crossmarkglobal.com. You can find his third quarter update to his 10 predictions for the year there as well, but we have a direct link to it in our show notes and on our guest page. And what I can predict is that Money Life will come back. We've got a contest that we're going to tell you about before we wrap things up on this edition. So stick around. The fun is not done until the show crosses the finish line.
Did you know that global generalizable robotics represent a $24 trillion investment opportunity? Top robotics and AI companies are actively reshaping industries across sectors. Learn more about capturing this investment opportunity at Vetify.com.
How do you top a terrific show? How about giving you a prize for listening all the way to the end? We have two really good books to talk about on this show. One we discussed yesterday with Paul Vigna. His book is The Almightier: How Money Became God, Greed Became Virtue, and Debt Became Sin. And today I had a conversation with Nick Majuli, and we were discussing The Wealth Ladder: Proven Strategies for Every Step of Your Financial Life. Now, if we have a contest or two contests, that means it's time for Rob Floyd, Money Life's executive producer and contest master, to tell you what you have to do to win. Hi, Rob.
Hi, Chuck. Yep, you're right. We've got two great possible prizes today.
And what have you cooked up for people to do to win them?
Well, I've combined the two books into one challenge, and it stems from one of your absolute favorite television shows, one with clips that gets a lot of airplay here on Money Life, namely South Park.
I like it already.
Well, I took the key elements from each book, the ladder from Nick's book and God from Paul's. And it made me think of South Park's famous Ladder to Heaven episode.
I love that one. It's like from season 6.
Well, you love all of them. But this one is the one where the boys build a ladder to heaven to see their friend Kenny, who has died again.
Yeah, that happens to him a lot.
Yep. But everyone thinks the boys are trying to get to heaven just because they miss their friend. And in reality, the boys are going there because they want something specific from Kenny. And that's what you need to tell us to be entered to win the books. Tell us what the boys hope to retrieve from Kenny to be entered into a drawing for the Almightier. And then tell us what the boys get or win if they get that item to win the Wealth Ladder.
Stan, Kyle, and Cartman do get what they are looking for, but they do not find it in heaven.
Well, that's not part of the challenge here.
So tell us what the South Park boys are trying to get from Kenny that prompts them to build the ladder to heaven to be entered for the Almightier, and tell us what they get if they find that item to be entered for the Wealth Ladder.
That's it. Send your answers and your name and address to chuck@moneylifeshow.com by 6 p.m. Eastern Time on Saturday, July 26th to enter. And Chuck will announce the winners on the July 28th show.
And please put the word contest in your entry. Good luck, everybody. Thanks, Rob.
And now for something completely different.
Now that the contest is out of the way, let's take a quick look at what we've got on tomorrow's show. Matt Miskin, Co-Chief Investment Strategist for John Hancock Investment Management, will be here. So will James Abate, Chief Investment Officer at Center Asset Management. So those are the headliners tomorrow, but there's a lot of great stuff coming. So be with us. Stick with us. It's going to be worth it. Meanwhile, if you're looking for something to celebrate, well, don't get too excited about the celebrations because it's National Hammock Day. And I have to say, I've got a big hammock. I haven't actually brought it out this year, and I need to. But it's also Summer Leisure Day. So, if it weren't for working to get the hammock out, I guess it would be leisurely to have it out, etc. It's also National Rat Catchers Day.
Who gives a rat's ass?
Well, maybe somebody who's caught a rat and has a rat's ass to give you, I guess. And then on the food front, it's National BLT Day, National Mango Day, and National Panouche Fudge Day. I'm not sure I said that right, but I think it's panouche. It's a lighter type of fudge. Not bad. My guests today were Jim Lee, founder of StratFi, stratfi.com, Nick Majuli, Chief Operating Officer, Ritholtz Wealth Management. His book is The Wealth Ladder: Proven Strategies for Every Step of Your Financial Life. Remember, his blog is ofdollarsanddata.com. And then Bob Dahl, Chief Investment Officer at Crossmark Global Investments, crossmarkglobal.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Nick Majuli, though it's not from his book and it was not from his interview. But he said, making money is mostly about avoiding big mistakes, not picking winners, not timing the market, just survive and let compound interest do its thing. Well, yeah, if you can do that, you will get to a spot where you reach your goals. Maybe slowly, but still you get there. And while you get there and you're getting there, remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again on Money Life tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
I'll never forget this time we spent together. I love you, always.